Well, hi everyone. Welcome to the Buffett and Beyond Research Saturday ETF report, January 5th, 2024. Folks, we're in the new year. And remember, if you want to live on the beach like Jimmy Buffett once did, you've got to invest even better than Warren Buffett does now. Well, let's look at the technology ETF, which gave a sell signal about, a week and a half ago. We mentioned that in our daily letter, and we said to go short or take on hedges. And we'll look at the XLK, that's the technology ETF we use, and we can see that it went up and reached a top in here and then fell down, and this green line is the 20-day exponential moving average, and you can see it broke right through that. Next line down here is the 50-day moving average. Now I want to show you something down here. First thing is the good thing. Good thing is this red volume, or these red vertical lines, represent the volume on the down days, and you can see that the volume has dropped off as the week went on. And I'm recording this in the middle of the day on Friday, so the day is not over yet. But with the volume dropping off, that means people are not scared and just selling willy-nilly. But the bad thing is that when we come back up here, we see this market made a higher high, but this indicator made a lower high. And that gives us what we call a divergence. And with this black line pointing down, that's negative for the market. So we're looking at the technology ETF here, and things don't look so well, which is why we're hedged. Now, let's look at the stocks that we have, the 6 stocks that we have in the technology ETF. And these are the top stocks rated by their clean surplus return on equity. And think of your bank when we talk about a return on equity. Bank account A might give you 10%, bank account B might give you 20%, and you would put your money in the bank account that has the highest return for you. We do the same thing with stocks using the clean surplus return on equity. So we have our stocks and we got the sell signal. So what we do in that case is we are always long the top stocks in that ETF. In this case, it's 6 stocks. Now, the XLK itself, which is the entire ETF made up of good stocks and also made up of the below average stocks. So we would rather be in the above average stocks and stay away from the below average stocks. So we go short the ETF, just sell it short, but we are long the top stocks. That means the top stocks will move better and faster to the upside than the entire ETF will, and all our research indicates that. So now we're going short this ETF and trying to protect the downward movement in our 6 top stocks. So our top stocks that we are long, we're down 5.7%. But since we're short the XLK, we are up this 4.6%. So the average is we're down 5.7% here. We're up 4.6% here because we're short this XLK. And that means our entire portfolio is down just 1.2%. And if this keeps falling going into next week or even the week after, we should be pretty well hedged. Not perfectly hedged, but pretty well hedged. And then we'll take our short position off. Now, a lot of you are worried about going short because you haven't done it before. But that's a whole nother story, and we've been going short for about 40 years. When you need to use it, you use it. And that's how we've been protecting our portfolios forever. So let's go to the QQQs now, and this is the NASDAQ 100 ETF. So it's the top stocks in the, or I should say the largest stocks in the NASDAQ, minus any financial stocks. And we can see, boy, oh boy, it looks about the same. And we can see that big rise up and then the fall down, the 20-day exponential moving average. We see the same thing with the volume. The volume is starting to get lower and lower, which means the selling is drying up as we are dropping. And here we have not exactly a divergence, but we have the same top here while the market made a higher high. So that gives us pause because this indicator did not go higher with the market. and the black line is still pointing down, and so we're saying, okay, we are in a decline, but how long will the decline last? Because as we look down here, we see that we are below this zero line, and therefore that's a good sign. That might mean that most of the selling is over, so we'll know this coming week, folks. And when we look at all the stocks that we have in our triple ETF, now this is made up of the top stocks in the Semiconductor ETF, in the Technology ETF, and we just looked at the Technology ETF, and also the QQQs that we have. So we have about 18 stocks in this portfolio, and we go short the QQQs to protect the portfolio. And the QQQs are down 3.3%. Remember, this is intraday on the 4th, which is Friday. And meanwhile, our stocks are down 4.7%. So we gained by our hedge, we gained 3.3%, but we lost 4.7% on our long list of stocks, and therefore we're down at 1.4%, but it's better than being down 4.7% if we just had the stocks in our portfolio. So that's how we hedge a portfolio, folks, by going short when these signals tell us that the market is going down and taking a rest in here. But things don't look very bad because of that volume drying up, and so maybe Monday we just might take some of the hedges off, but we don't know until we get those signals. So folks, we had a bit of a down week this past week, and that was after a 2-month period of rally in the market. So we're pretty happy, and our portfolios are hedged, so we're pretty happy there. So we'll just go out this week and we'll take a walk on the beach, or if we're up north, we'll take a walk in our snowshoes, and we'll get out of the house a little bit, and then we'll come back in, be with the family, have a dinner, be with your loved ones, and folks, we'll see you back here next week. Be safe. We'll see you then.